Okay, so let's go to page 4, revenues.
Mhm.
So revenues are also a little bit, this is actually the biggest difference. Government-wide accounting is just like regular accounting, except when it comes to these revenues. Because in normal business, we have revenues must be earned. But there aren't any earning of revenues in governmental accounting.
Mhm.
They don't, um, it's just to fund those things that the public won't fund through private. You know, no one's going to have their own police force, so
Mhm.
no one's going to have their own fire department. So it's funding those things that generally are not going to be funded by individuals, and there is some idea that also if it can be done in the free market, that it should be done in the free market. The government shouldn't be making this whole socialism, communism, all that kind of stuff.
Mhm.
In this country, we basically say those things that won't be provided by normal business should be provided by the government. So repairing the streets, no one wants to pay for all those streets repairs, but they have to be repaired. So that's the whole kind of thing. So there is no actual earned revenue. It isn't like you pay your property taxes and you get back something in return.
Mhm.
So there are no direct benefits, and generally you recognize, for instance, property taxes are recognized when they're levied. And another thing that you'll sometimes see is that there'll be, um, it's almost like an extreme accrual, in that the money hasn't changed hands yet, but you send out that property tax bill, and even though you haven't done any service or anything like that, you recognize that as revenue for the year because you're going to use it for that year. Okay. And revenues are recognized for the current year plus 60 days. I think we talked about this already, didn't we?
Mhm.
So,
Right. That you have 2 months to collect.
yeah, basically, yeah. So you're going to collect in the, and then going into the next year, um, the next, 2 months into the next year, that whatever comes in is counted in the current year.
Mhm.
Things that are not collected in that period that are still there will go on. There's 2 different terms that you can actually use for that. One is unavailable, and the other one is deferred revenue.
Oh,
You'll
okay.
actually see deferred revenue more often. What you won't see is unearned revenue, because we don't earn revenue.
Right.
So there's no earned revenue or unearned revenue.
Mhm.
So if they only say revenue that's unavailable, and usually they have a year, they'll say, okay, unavailable revenue, and they'll say 2022, or deferred revenue 2022. And that is the money that's collected on that assessment, even though it was in the previous year, but was collected later on. It'll be in their budget. It'll basically be in their budget. They'll say, okay, there's $50,000 of property taxes that we haven't collected yet, and we're going to include that in our budget because we think we're going to collect those after the 60 days into the new year. So there's it's a year plus 60 basically, but that's only for what's levied. If they levy the taxes in the following year and someone pays them early, that doesn't count in the current year. It's only for those taxes that are levied in the previous year.
Mhm.
Okay. Taxes that are not collected by year end will usually be marked as delinquent. And you do that for 2 reasons. First of all, to separate out the taxes that are unpaid from the previous year. But also, a lot of times we'll tack on interest and penalties. So the interest and penalties will also be tacked on. Now, you'll notice that there's an estimated uncollectible taxes. Just like accounts receivable, there's going to be an estimated uncollectible. Same thing for government. And what they mean is that it will not be collected in the current period or after the 60 days. There's some, there's just something more. And a lot of times, for instance, these interest and penalties fall in the same category. If the people couldn't pay the property tax bill, at the regular amount, adding interest and penalties doesn't make it any easier to pay it.
Right.
A lot of times these are also have a fairly high uncollectible rate, at year end. So, and again, that just goes by those things that aren't collected. A lot of times will have proportionally will be higher, because if they haven't paid it yet, there's more chance they won't be able to pay it going into the future. So it's just like, and that's just like regular accounts receivable, with the exception of down here that a lot of times interest and penalties gets added down to it. Okay. Other financing sources. And other financing sources, it transfers in. A lot of times these are grants. So grant money. You get a grant for a new emergency whatever system, that those would be included in the budget as money coming in.
And that's if it's a private grant or like a grant from a different government agency?
Correct. Yep. Yeah, and sometimes you have weird ones too, that people will give money to, large amounts of money and stuff to cities or libraries or whatever. So yeah, it can come from any source, that transfers in. Now, usually transfers in are going to be grants and things like that, but they could be other things too. Actually, when I think about it, transfers in, I think it would be other, I think I just said something wrong. Transfers in are going to be from other funds. If someone were to donate, I think it would come in as other financing, outside sources, I think. Let me look that one up. I think, but the more I think about it, transfers are only from other funds. Let me look at that. Now, if they've already set up the fund themselves, if they've already set up a fund for it in a transfer, so if someone donates money and it goes into a special fund, from that special fund, it would be a transfer. If someone were to simply give the money to the township or state or whatever it is, I think that would be outside sources, but I'll look that one up.
Okay.
But so if they gave the money from someone on the outside, if it came from outside sources, but it was in a fund itself, a special fund. So, for instance, someone donates money that can only be used for the library. If that's set up as a fund itself, then it's a transfer. If someone simply donates money to the city for whatever reason, in their will, they say, "I love my city," and again, they gave this money.
Right.
I think that's the outside source. I'll check on that though. So if it's not actually set up in the fund, then it's an outside source. Okay, yeah. So transfers from other funds, the transfers in. Bonds are them issuing bonds or selling bonds, however you want to say it. So and a lot of times cities will do this. Bond interest from government agencies, and I'm sure you know that they have a special. They're not the interest isn't taxable usually, and they do that to make it easier for cities and states to sell bonds that people don't have to pay federal taxes on the interest they make. It could be other things too. It could be, almost anything: sale of land, sale of equipment, sale. There's other things too that the city could be doing that are not taxes, not revenues, but other ways of getting money in. And those could be, like a sale of land, sale of equipment, sale of whatever. Common ones. Okay. So, other financing sources, other financing, and then we also have other financing uses, which we'll get to later. But anyway, these are kind of the usually the big ones when it comes to money coming in. And again, one of the things you realize in governmental accounting is that it's much more focused on the different types of how to get money in, because they have this chunk of expenses, and they usually just have it listed as expenses or expenditures. This is how much we need. How do we get it? That's kind of the whole point of it. All right. So this is a weird one. Budgetary accounts of the year. Encumbrances, which is probably something people who don't deal with governmental accounting have never seen.
Mm-hmm.
If you've never seen those, you're in the majority. Encumbrances. When you make a purchase order, usually for things that are not part of the normal business, for instance, or usually don't use these for payroll or something like that.
Mm-hmm.
But when you have a purchase order, you make a purchase order, the city needs to buy a new lawnmower. Okay.
Mm-hmm.
Make a purchase order for lawnmower. You put your hand on that money and tell them, and so if someone sees an encumbrance, you're telling them, look, you can't spend this money. It's already spent. There is a purchase order connected to this encumbrance. So a purchase order will, you'll put your hand on the money.
Mm-hmm.
When the item comes in, you take your hand off the money. So just like our budget account we have for the budget at the beginning of the year, these accounts are kind of the same thing. You put your hand on the money. Once the item comes in and you spend the money, you take your hand off it. So it just reverses out. And it's there just so that people don't, that more than one,
Right.
Group or person or whatever doesn't spend the same money.
Okay.
Oftentimes the appropriations, they'll make the appropriations for the budget at the beginning of the year. So these, a lot of times they'll have purchase orders for them set up. That's not how you spell orders. Okay, so they'll set up the appropriations, they get approved, and on the first of the year, a lot of times they'll cut all those purchase orders. They'll say, okay, we need X, Y, and Z, and they'll cut those purchase orders, or at least issue those purchase orders. And at that point in time, so some of these appropriations will actually be encumbered.
Mm-hmm.
So if there's appropriation for whatever, for buying new fire trucks, once they do these appropriations, a lot of times the first day of the year, they cut the purchase order, and that purchase order will be encumbered. So people looking at the encumbrances will know, okay, that money's already spent. There's already $112,000 for the new fire truck, whatever. I don't know how much fire trucks cost, probably more than that. But anyway, that those purchase orders would immediately become encumbrances.
So even if they're not planning on buying it till October, the money is still sitting in that encumbrance.
And that's exactly why they do it. They don't want somebody looking at the books and saying, "Oh, look at all this money that's left over." It's not left over. There's purchase orders. So they'll cut those purchase orders a lot of times or put them in the system, and when the appropriations are approved of what they're going to buy and they have installed or whatever, they'll cut those purchase orders and they will also encumber those at the same time.
Mm-hmm.
So exactly for that purpose. Somebody doesn't look in February and say, "Oh, look at all this extra money, I can spend it," because there's actually encumbrances that are going to come in March or whatever. Encumbrances that are not filled in the current year may be filled in later years. So for whatever reason, the purchase got delayed, you can still keep the encumbrance there for the previous year. You'll have it listed as a 2021 encumbrance, even though you're in 2022. It'll say, okay, yeah, we're still going to buy that thing, but that has to do with the budget from the previous year. If you cancel an order, you obviously take the encumbrance off. So you order a fire truck and they can't deliver it, and you cancel the order, then you take the encumbrance off, take your hand off the money. Okay. I think I talked a little bit about this before. Expenditures are different than expenses. Expenses are basically a way of determining income. We don't have income in governmental accounting, but we do have to write checks, and so we talk about expenditures, payments. And in regular accounting, if you buy a truck, you say, okay, this truck's going to last for 10 years. We'll depreciate it over 10 years. We'll allocate a little bit every year for the next 10 years to expense it. We don't do that in governmental accounting. In governmental accounting, it's simply we bought a truck, it's an expenditure. So, whether you're paying utilities, buying supplies, buy a truck, buy a building, it's an expenditure. They're all the same. You might have a little description beside the expenditure, but it's an expenditure. It's money going out.
Mm-hmm.
And so when you see, a lot of times on the financial statements, this is expenditures. So, okay. And this is one of those things that is also done in business, but it is done in government. Let me turn this air conditioner off. Sorry. It's a little air conditioning. It used to be really quiet. Now it's getting noisier. It's getting crabby.
Mm-hmm.
Okay, so voucher payable system is a lot of companies will have this. They either accounts payable or vouchers payable. Many companies have vouchers payable, and what it is the approval process for accounts payable. And let's see here. It's basically this, and this goes for accounts payable too. This isn't just for vouchers payable. Before you pay something, you generally do this. You have a purchase order, and then you want to know that you got it, so you get, spacing's really weird here. Your receiving report, and then you match it up with a vendor invoice. I don't know. All right, so these are the three things that you match up. And this is if you're going to pay accounts payable. Also, before you pay it, purchase order, did we order it? Receiving report, did we receive it? And a vendor invoice. And the vendor invoice usually will have the prices that match up with the purchase order. Once all those are in agreement, we ordered it, we received it, and the invoice, we paid it. Okay, so that's accounts payable. In a voucher system, those things are all matched up, but it goes from being a accounts payable to a vouchers payable. Sometimes they'll go right to it, and once the voucher is approved, it's then paid. So we're really just talking about schematics. If you had the purchase order, receiving report, and vendor's invoice, those are all canceled and then paid. In a voucher system, those three things are canceled. A vouchers payable is issued for being allowed to be paid. The vouchers payable is paid. So anytime there's a vouchers payable, that it will be paid, basically. So that's a voucher system. It's exactly the same as accounts payable.
Right.
That a lot of times it'll go from being accounts payable to a vouchers payable. But it's basically if there's an approved voucher, it gets paid. And a lot of companies use them. It is possible to have an accounts payable that, when those two things come together, you put it on as accounts payable and then accounts payable is paid. But it also could be that you put it on as a vouchers payable and then the vouchers payable continues on it by itself to be paid. It's kind of a weird system, but but they use it. It's basically that all the conditions have been met. Now it's allowed to be paid, rather than all the conditions are met, we pay it. So one is immediate, the other one is kind of goes into the system. And usually you'll see this, and a lot of companies use both. It'll be an accounts payable until they get the three documents, then it becomes a vouchers payable. So there really isn't too much difference to it, other than it's just a billing thing, how they do the billing. But they both require the same things. And you take the CPA exam, these are the things that they're going to ask you about, receiving reports and all that kind of stuff. Purchase order, if you match these three things up, usually there's not a problem. And it could be that, and now the purchase order does not necessarily have to match up with the receiving report. You order 10 things, they ship 6 of them.
Right.
Then they should only bill you for 6 of them. So the receiving report will generally should match up with the vendor invoice. Not necessarily the purchase order, because a lot of times shortages or whatever that you don't get on everything. But whatever you order should have been on the purchase order. So if they sent something that wasn't ordered or they over shipped it, that's a problem. I don't know. You guys talking in your class about channel stuffing?
What's that specifically? I don't know.
Channel stuffing is a lot of times companies did this at the end of the year. Someone would order 50,000 items for December. You ship them 100,000.
Okay.
You bill them 100,000. The next year they send them back.
Yeah, we used to do that at the company I worked at.
Yeah, well, you can't do that anymore. The new revenue rules are that, and again, it was channel stuffing was one of those things that people didn't do too often because they irritated their customers. But business, some bad business practices were that they were doing. So anyway, now if it was, the revenue standards are that you really can't do that anymore. So you'll have to pull it because in the past companies would then write that off as a return in the following year. Whereas now they say, okay, if it's significant, you have to include it in the current year. So you don't see that as much anymore.
Right.
Funniest one that happened was Krispy Kreme. Krispy Kreme was very profitable, and then one year they were going to have a loss. They sent all these donuts out. What do they do with all the donuts? And it costs all the money to make the donuts and sell them, ship all this stuff. And But yeah, Krispy Kreme channel stuff.
Hmm.
But
It's not like you can send them out next year to somebody else. They're going to be stale.
well, that's the thing. They basically blew a bunch of money, and it made them look really bad.
Mhm.
And I think they had to restate their financial statements. I think the SEC got them on that. But yeah, so channel stuffing is one of those things that they try to. But there's another thing here though too. One of the things that if you're doing auditing, is that you'll be looking for receiving reports. If a company has receiving reports, there should be some kind of liability set up, even if it's not assigned to a certain vendor or something. So one of the things you look for when you're doing auditing is receiving reports that, maybe they're just waiting for the vendor invoice. But if they sent a purchase order out and they received it, there's a liability. They have the goods, it's a liability. So sometimes there is some logistic stuff in here that you do for auditing. But yeah, those are the three things they have to match up for any payable before it gets paid. Generally that's done in the accounts receivable department, and the accounts receivable department will approve it. The accounts receivable department does not write the checks. Usually Treasury writes the checks. So even though they approve it, they have authorization, they don't actually write the checks. But anyway, so this vouchers payable system is basically the same as accounts payable.
Mm-hmm.
The documents that are added are exactly the same. In governmental accounting, we usually go right to the vouchers payable.
Mm-hmm.
So this is instead of like accounts payable, vouchers payable, and then they'll all get put into paid at the end of the month or whatever they are. Okay, so okay, that's pretty wacky. The encumbrances are the wacky thing. It's only for governmental accounting or fund accounting, and it's only for purchase orders, basically, to put your hand on money so that people don't spend the same thing twice.
Right.
Okay. And by the way, we're going to do examples of these, so
Sure.
Hopefully it'll make more sense. Payables. So when you have payables, I just put this as vouchers payable because that's what you're going to see usually.
Mm-hmm.
Payables are owed to outside vendors. Use voucher payable. Payables owed to another fund use due to. So there's a big difference between the outside world and the fund in the governmental world. People who are in or groups that are in the governmental world, we use due to and due from. It's not dealing with the public or private business.
Mm-hmm.
It's within the government. So the state of Illinois and the city of Chicago, they will have due to and due from. So if we owe if the city of Chicago owes something to the state of Illinois, they collect sales taxes, for example, at O'Hare. They collect sales taxes at O'Hare, and they owe that to the state government. They'll have a due to state government.
Mm-hmm.
And again, this works for cities and states and federal governments. If it's a government agency, if it's not dealing with a private company or private individual. So people on the outside, if they're private, business or individual, there's payables. Inside, due to. And receivables kind of are the same way.
Mm-hmm.
receivables, people on the outside, they're just receivables. Taxes receivable. If someone owes you taxes, it's taxes receivable. That's people on the outside. If it is from one government agency to the other, it's due from. So due tos and due froms are what we do for government agencies. We don't have payables and receivables. So if you see a due to or due from, you know that it's inside the governments. It has nothing to do with people on the outside. If it is a payable or receivable, it's on the outside. So it's kind of us and them. If it's a government agency, due to, due from. Outside, regular old payable, regular old receivable. Yeah, so that's a little bit strange. But if you, I should pull up a CAFR's a report and kind of go over it. Okay. The fund balance itself. The fund balance itself is, it's similar to equity accounts. It's similar to, say, common stock, retained earnings, except that nobody owns it. So there is no common stock, there is no retained earnings. So we just talk about it as a fund balance. And that is how much money is basically still in the bank. Yeah, for government wide, it's a little bit bigger than that, but basically it's for how much can you still spend is there. So yeah, so current assets, we only have current assets. We don't have long-term assets. We don't have buildings. We don't have streets. We don't have equipment. So current assets basically are cash for the most part. So assets equal liabilities plus fund balance. And these are the only current liabilities, what we're going to pay in the next year. And then what's ever left over is the fund balance. So like in your checkbook, how much cash do you have? How much do you owe? And then how much is left over? Okay, I got $5,000 in my checking account. I have to pay $3,000 in bills. Then I have $2,000 left over. That's all it is. How much the fund balance is really how much can you spend? It's what's left in the checkbook. Okay. Now, I think I got my spacing wrong here. Oh, no, I did. Oh, excuse me. Fund balance used to be really easy. It used to be fund balance reserved or fund balance, this fund balance or fund balance unreserved. We used to have two categories. Now, we have 5. Okay, and the 5 say, okay, there's different kinds. There are funds that are open that you can spend on anything, but then there's also these other categories of funds that cannot be used for other purposes. So it's sort of like the special revenue fund kind of thing. It's that these are funds that can only be used for whatever. These are funds that can only be used for the road or whatever. A lot of times these will be ones that are committed to purchase orders. There's a purchase order that goes into the next year. Set aside part of that fund balance, say, okay, look, we got a $13,000 piece of equipment that's coming in next year. You can't spend this. It's already been spent. It's you can't do it. Okay. The first one is kind of funny a little bit in that it's fund balance non-spendable. It's for things that aren't cash. For instance, if they have on their books current assets of, say, office supplies. Some places don't do this. Some places don't have office supplies in their fund balance. But if they do, they say, look, we have $3,000 of office supplies. You can't spend that. It's already spent. It's in office supplies. So if there's any non-cash funds, those are called non-spendable, and they're not spendable just because they're not cash.
Mm-hmm. But those would be office supplies that are not currently in use, or could they be in use? Like if it's,
I think we use, the supplies that you have at the end of the year. Someone goes out and counts up the supplies. Okay, we have 2,500 of office supplies.
mm-hmm.
Okay, so that's in the fund balance that you have. If you include supplies in the fund balance, some places don't.
Right.
But if you include it in there, they might do it for control purposes or whatever. If you include those office supplies in the fund balance, then you got to tell people, look, this isn't cash, so you can't spend this on something. This is in envelopes and stuff. Right? You can't pay for this in envelopes, so So anyway, the non-spendable is basically things that are not cash. Okay, now these next three are the kind of wacky ones that are very similar, but it really has to go to what the authority is as far as what each of these, how they kind of differentiate these. Okay, so the first one is the restricted. And this is the highest level. So these are things that are restricted, includes amounts that can only be spent for specific purposes by Constitution. Give me 1 second. I'm in a class.
Oh, sorry.
In the summer, I don't have classes. This is the only blue class I have. So, okay. So the Constitution or somebody, an external source is providing it so that you can only use it for this. The state is giving you this amount of money, but you can only use it for police, capital spending or whatever it is, or through enabling legislation, which I'd have to look that one up exactly what that means. Mm-hmm. But anyway, it's at a high level. Constitution. Someone from the outside says you can only use it for this, or enabling legislation. I'm not sure what that is. I'll look that one up. I should know that. But anyway, so this is the highest level, and it's usually there because it basically cannot be changed. You can't change. You can't say, okay, we're not going to use it for police equipment. Then no. The state gave it to you. You can only use it for police equipment. Okay. So the next one is fund balance committed. They can only be used for the specific determined by formal action of the government's highest level decision-making authority. Okay, so what this is saying is the government itself, the smaller, not the federal government, whatever this unit is, the highest level that they've made this commitment that they're going to do this. We're going to repair the sidewalks. The difference being is that many of these can be reversed. If the government gives you money that you can only spend on sidewalks, you can only spend it on sidewalks. If the federal government or whatever, you can't change that. It's restricted. If it's a local government that says we're gonna fix the sidewalks, and something else happens, they can say, okay, well, we're not going to fix the sidewalks. We're going to do something else. So this is the highest level, and this is the next kind of level that we're going to have. So we'll say this is the medium level. And that is that it can only be used for that purpose. However, it's possible that it could be changed. Okay. and assign. And this is amounts assigned fund balance classification that are tend to be used by the government for specific purposes, but do not meet the criteria to be classified as restricted or committed. So this would be something that's done at a lower level than the highest level for the local government. So the highest level maybe is the the board, the village board or whatever it is, or city board. This might be something, say a superintendent at a school might say, we're going to use this for this purpose. Now, it's not the highest level, but it is being assigned to funds that you can't use it for anything else. So this is the lowest level. And again, this could be changed too, usually at a local level that, that someone could say, no, we whatever it is, we can't do that. We have to do something else with this money. So the first one is people on the outside, whatever they give you money, that these cannot be changed locally. These two can be changed locally. This is at the highest level. This is at a lower level. Okay. In the government funds other than general fund, assigned balance represents the remaining amount that is not restricted or committed. Did I already say that? I don't know. I put that in there. I'm not sure. It's probably a cut and paste error or something. I'm like, it's in there twice, I think. So it's not restricted or committed. A lot of times they're made by people who have the authority to do it, but they are not the highest level of the government. Mm-hmm. So the school board, they're not the highest of that, of all the governments. So if they did something in the, say, board of directors of the town, they may have a different idea. They're not the highest level, but they do have the authority to do it in their capacity. Okay, fund balance unassigned. This is the stuff that is available to people to use. So this is, you can use it for anything. You can use it for schools, you can use it for streets, you can use this for police, fire, anything. So fund balance unassigned. It used to be, restricted and unrestricted. That's all we had. Now, not restricted. Reserved. It used to be reserved or not reserved. This is sort of the not reserved one. Anyway, the feeling is that what they want to have is that so that people reading it know that this is an inventory. You can't spend inventory.
Right.
And these here, they feel gives more information. Who is actually calling the shots on these things that are reserved? Is it the federal government that we can't change? Is it local government? Is this somebody's pet project that can be changed? The mayor has a pet project that can be changed. Mm-hmm. So committed and assigned. And I know that these are very similar. Taking the CPA exam and restricted. Would this be restricted, committed, or assigned? It's very hard. If you just think that restricted is the highest, it's strict. It's the highest level. These other two, committed and assigned, can both be. They can be changed at the local level. So
when you're looking at that, does it say? Would that say when you say like restricted fund balance? Would it say like who is restricting it or who can change it? It does it, or is it just it's assuming that the reader can like figure that out?
It's they usually they probably won't have it in the financial statements themselves unless it's a fairly small place, but a small city or whatever. But they'll certainly have it in the detail. They'll certainly have the detail of all those accounts will be given. Let me see if I should have a CAFR report here somewhere. It sounds funny, but that's what they call them. A CAFR. No CAFR report? How can I not have a CAFR report? quick search for CAFR. I almost always did one for the city of Chicago. This doesn't look very likely. I don't do all these. I have got to have a CAFR report here somewhere. Anyway, a CAFR. It did just tell you what a CAFR report is. All your cities and so forth will have reports they put out. It's a very extensive report, and it will have all of the documentation. It actually, compared to, say, an annual report for a company, they're usually very involved. They're very extensive.
Mm-hmm.
Oh, test bank stuff. I'm gonna do one thing here, and then I'm gonna knock it off. Where would it be? I'll look for it later. Yeah, but the
Sorry, I need to let my dog out. Sorry, he let himself in and then he can't get himself out.
all right. Well, that's searching. Something else here. Okay, so that's it for that. So what we're going to do now is go to the second handout.
Right.
Okay, so this is for the general fund. So this is going to be the wacky one.
Mm-hmm.
Just because we use all the weird accounts we have. And so this is kind of the checkbook one. And let's see if I have a CAFR. Do you find CAFRs anywhere? You gotta be kidding me. I used to always use the city of Chicago, and negatively I'd always show how it's going bankrupt, and they show the state's going bankrupt. It's kind of depressing, probably why I took it off. 500 pages of depressing information. Okay, so budget approved on January 1st. The following, we have estimated revenues and estimated other financing sources of bond issues. So this is all money coming in.
Mm-hmm.
And then this is all money going out. Okay, so Estimated revenues. Now, again, normally revenues are credits. You know, but
Right.
second week in the accounting 110, revenues are always credits, or we debit them here. This is a closing entry. Oops. That's done on the first day. So the estimated revenues are 160. Estimated other financing sources. Oops. By the way, you'll also see these as other financing sources. You'll see these listed as OFS. Kind of like we have AP for accounts payable. Other times you see OFS as other financing sources.
Yeah.
And that is 30,000. And then we go to the credits. Now, appropriations, these are the estimated expenditures. They don't call them that, though. They call them appropriations.
Right.
I think I saw a CPA question one time that was, which of these is not a government budgetary account? And they had estimated expenditures, and that was the one that wasn't. So we don't
Because they're appropriations.
Exactly. Appropriations be 164,000. And estimated other financing use. You'll see this as OFU. Make sure you only use that when you're around people that know what you're doing. Transfers out. Okay, so other financing uses. Okay. Anyway, other financing uses, OFU, transfers out. This is what you plan on giving to other funds to spend. You're not going to spend it yourself. You're going to give it to education fund or whatever it is.
Right.
Okay. So the plug number here is we have about 190,000 of debits. Oops.
Right.
And 186. Okay, so these two don't
match. Yeah.
So we have to do a fund balance. Now this is important also. This is a budgetary fund balance. And then what do we need? 4,000 to make that balance. And again, the word budgetary here is very important. So you remember that we had the fund balances, we had the restricted, the committed, the assigned, and the, I forget what they were, the unassigned, or whatever it's called. We don't have, there. You didn't see budgetary in there.
Mm-hmm.
The AICPA does not count the budgetary fund balance as a fund balance. It's a budgeting account. It is not actually a fund balance. So this is a budgetary account. And so you have to say budgetary fund balance. This is what we think the fund balance will grow to if all of this works out. If if these revenues work out, that's what you pay. If these are what we end up paying out, then this is what will go into the fund balance.
Mm-hmm.
And the question is this a balanced budget? Yeah, it has to be, because you're taking in more than you're paying out.
Right.
And so this budgetary fund balance, and that would change this obviously to 90. So budgetary fund balance, that is not a fund balance you'll see on any other financial statement.
But you see it on the budget because you have to balance it out. So is that money just considered like in case, or like it's okay?
It's considered. It really is an estimate of what you're going to have in at the end of the year.
Mm-hmm.
At the beginning of the year, you're probably not going to have anywhere near that, because you send out the tax bill and they don't get paid for 6 months or whatever. But so the budgetary fund balance will be what you estimate that you'll add to or subtract from the account at the end of the year. In this case, you're going to add to it. You see 190 is coming in, or not you, but whoever whatever this is for. They have 190 coming in. They have 186,000 going out. So you're saying, okay, the fund balance will grow by 4,000. And the reason I'm really emphasizing this budgetary fund balance, because there were times when you could put it in the regular balance. You could put it in as a regular fund balance that would show up on the financial statements.
Mm-hmm.
They don't allow, or at least the AICPA, when they do the testing, they don't allow that anymore. I believe it is. I don't think there actually is a rule against it. But well, other than they tell you that these are the 5 categories of it. Mm-hmm. So that would probably maybe preclude it. But it used to go right into some places used a budgetary fund balance. Some places used the regular fund balance. Let's say, okay, we estimate this is what we're going to have. We think this is what we're going to have. So we think that this was going to be left over in the fund, and that's it. They would book it basically. But anyway, nowadays we must use this budgetary fund balance. Let me see if I found a CAFR's report. I'm in disbelief. I don't have a CAFR's report. Let me try something else, and then I'll give up. There's one thing I want my students to know is that if it gets really tough, just give up. Oh, this is going to show everything from the Chicago. All right, well, we'll look back. I'll do them for a while. Okay, so you want to try the second one?
Yeah.
All right.
Okay, so 7.1, we'd have estimated revenues as a debit for $2 million, and the estimated OFS for transfers would also be a debit for 100,000, And then the appropriations would be a credit for 1,950,000. And the estimated OFU would be 200,000. So let's see. So that would be so actually, so then would we have a debit of a budgetary fund loss? Because did I?
Yeah, it'd be a reduction. Yeah, budgetary fund balance. Now, it still might be a legal budget
Mhm.
if you have fund balance to cover that. So let's see. So what do we have? 2,100,000. Oops. Yeah, what is it? 2,150,000. Yeah. So you come down here, and this would be
Right.
So you say, okay, I need 50. Wait a minute, did I do that right? Yeah.
Yeah.
So 50,000.
So we're planning on spending more than we're planning on bringing in.
Yep. And if there's fund balance to cover that, there's not a problem. So if the fund balance has, 320,000 in it, well, that's fine. Let's say, it's still a balanced budget. It's still a legal budget.
Mm-hmm.
And you'll be estimating that your budget will go, that your fund balance will go down by 50,000.
Okay.
I think my sister was in a place where usually cities will like to have 40 to 50% of their total expenses for a year or expenditures for the year be in a fund balance. And I think my sister, where she was at, they had 4 years worth.
Oh, wow.
Yeah, so people were kind of complaining, like, you're collecting all these taxes and you're not doing anything with them. So they said, okay,
Mhm.
well, we'll start whittling it down. But yeah, so this is what it looked like. And again, if they have the money to cover it, it's fine. If they don't have the money to cover it, then they have to go back to the drawing board and
Mm-hmm.
either find more revenues or eliminate some of these expenditures. I'm in disbelief that I don't have a CAFRS report. Okay. So let's go to property tax revenue. Okay, now again, those property tax revenue. These are taxes that are levied on individuals, residents, family, or whatever,
Mm-hmm.
or businesses. These are people outside the government. So are these going to be receivables or due froms?
So they are going to be receivables.
Yep, exactly. They're not billing another government. If they happen to be billing another government, in for some weird transaction, it would be a due from. But these are generally going to be property taxes receivable, or we can use taxes receivable.
Mm-hmm.
Okay, it's estimated at 15,000 of taxes will be uncollectible.
Mm-hmm.
That 20,000 of taxes will not be collected until 60 days after the end of the year. So there's 20,000 that we can't count as revenue in this year,
Right.
and the rest will be revenue. Okay, so we levy taxes for 200. So we sent out bills, and we sent out bills for. Fix this thing. And my desk doesn't work right, and I actually have bought 4 of these desks, and my kid has 2 of them.
Mm-hmm.
His work perfectly. All right, so say taxes receivable. We don't give a year here. I'm going to put a year on here. Usually you have you'll say current, and you probably have a year in there. Oops, that's not a year. So you'll say, okay, we sent out bills for 280,000. Now we can't count that all as revenues because we are not going to collect. We estimate we're not going to collect 15,000 of it. So all right, so we're saying that 15,000 of it we probably will not get.
Right.
At least not in the foreseeable future.
Mm-hmm.
Right, you know, property tax. You know, sometimes the city will seize a place for property taxes and all that kind of stuff. But sometimes they don't collect it at all, and sometimes because they want to get somebody else in there, so they'll waive the taxes and all that kind of stuff. But we're saying is that in the future, we don't see it in the foreseeable future. Okay, now I forget what the term they use in the other one they have, but you generally see these called deferred revenues. Deferred revenues, and these are revenues that you will not have in the current year. Most likely, these will be available in 2022. Say the next year. I'll put dates on the next one. It's not going to help you, but future people will know. So, the current year, let's say it's 2021. Deferred revenues 2022. So they'll be able to recognize those as revenues in 2022. We won't because we won't have them in 60 days. And then this will be our revenue.
Mm-hmm.
And you might say property tax revenue or something like that, but
Mm-hmm.
whatever. So it's 80,000.
245,000.
Yep. And so this would be our revenue in the current year. This is the amount that we would have.
Okay.
All right. Let's jump to number 5.
Sure.
Oh, and I got dates on here. 2018, 2019. That's when I was born. All right. Okay, so actually, I should change the one to 2018, 2019. But anyway, so 2018 property tax amount of 400,000 is estimated that 100,000 of the property tax will be uncollectible. There's a journal entry. all the net taxes receivable will be collected within 60 days of the end of the year. Okay. So this is kind of taking us all the way through the collection and all that.
Right.
So the original property tax collection will be what?
So the original will just be estimated revenues.
It will be estimated.
Oh, this is saying at the end of this is what you're preparing after you've already collected.
No. This is just like the one we just did.
Oh, okay.
So, and again, I know it sounds strange, but the second you send out those bills, it's counted as revenue. So this will be part of the, there's estimated revenue. This is real revenue.
Okay, so it's just considered taxes receivable for the 400,000 that we sent out.
Yes.
Okay.
And again, this revenue is real. That's kind of the strange thing about it is
right.
This isn't estimated. This is, this is you count that immediately when you send out those tax bills. Uncollectible. Oh, I should probably say this is current. I'll use the date we use here, 2018.
Mm-hmm.
So we got to talk about current 2018, 10,000. We don't have any deferred. So this will be the revenue.
Mm-hmm.
And again, this is real revenue. This is, even though we haven't collected a dime, we haven't earned anything.
Right.
Sent the bills out, we count it as revenue. So this would be 390,000.
Mm-hmm.
That would be, and so this would be what we'd count as revenue. Okay, as of June 30th, 365,000 property taxes levy had been collected.
Mm-hmm.
Okay, so we collected the cash for this, and we have to take 365,000 of those off the books. Okay, so cash goes up by 365. And we have to take this off the books.
Right.
Some of them, 365. Okay, so 365. All right, so and this is the, oops. So of the taxes receivable, we've taken 365 off the books, we've collected cash of that. I don't know why I left all these spaces in here. Actually, maybe I might know for this one. Okay, so the uncollected property taxes are reclassified as delinquent. Okay, so
Right.
the question is, how much do we still have in our taxes receivable?
So it would be the 35,000.
Yep. So we're going to reclassify that. So we're going to take off these taxes receivable.
Mm-hmm.
I did this wrong. Let me do this again. We're going to take them off the credit. You know, I'm going to copy that. Okay. So we still have 35,000 we have to take off the books.
Right.
We're going to put that into taxes receivable delinquent. And we probably put the date in, or the year.
And they're still considered delinquent in 2018, even though they're getting kicked to 2019. They're still
Yeah.
the 2008, right? Okay, perfect.
Well, a lot of people pay them going into 2019. They need to know which taxes are they paying. Are they paying for last year's taxes or this year's
Right.
taxes?
Right.
So this would be, paying off the previous year's taxes of 35,000 for last year. So, and again, you may have several years worth on here. It's
Mm-hmm.
happens. People, houses burn down. People die. People leave the country. Okay, there's all kinds of reasons why you may not have this turned around right away.
Right.
Now, we also have to take off one more thing.
Oh,
It's being uncollectible current. So there are no current
right.
for 2018. There's no longer those. So we have to take those off the books too. So it's being uncollectible current. And the new amount I probably don't have a phone for 2018.
Hmm.
I'll try to make some space here. Oops. Okay, so that'd be 10,000. So we're probably planning on collecting the other, 25,000 of
Okay.
this. They're probably expecting the next year that we'll collect it. So we've taken the current receivables off the books. Let me make those up. So we've taken those. We've taken the rest of the accounts receivable off the books. We've brought those current ones down, taken those off the books, and so this is really all that's left. This is what's
Right.
going to be going into the future from this year. Now, in 2019, the process is going to start all over again.
Right.
2019, they're going to have an entry like this,
Mm-hmm.
and those will be 2019 current tax receivable. These will still be on the books as 2018 will be delinquent receivables and delinquent
Right.
estimated uncollectible.
Because they're estimating they will collect tax revenue for 2018 in the amount of 25,000.
Right, within the next 60 days.
Right.
And if it was longer than 60 days, it should have been up here,
Right.
But it could be, you could also, it could also be reclassified too, though. As, if it is going to be collected in the future in longer days. But anyway, there's always adjustments made to estimated. But anyway, so this will be, the green will be the only thing that's left from 2018. And then again, the new year will start, and it'll start all over again. But again, you could have delinquent taxes going many years back. And a lot of times, usually someone buys a property, they have to pay up for the previous delinquent taxes. Sometimes they cut deals with them and stuff. They get rid of all the penalties if you just pay for the all kinds of stuff like that. But generally they'll make it up. Sometimes not, but I think I don't know.
Just trying to get rid of it, basically.
Yeah, well, and they want to have somebody in there that'll pay. It's kind of funny is that in I guess in Detroit for a while they had a lot of these property taxes for these houses that no one wanted. People were abandoning the city, so some people wouldn't pay their taxes. It would go to auction, and they'd literally go buy their house back every year for like the starting bid was like $200 or something. So they wouldn't pay their $6,000 property taxes, and they would go buy their house back for $200. But anyway, I think. Yeah, do I want to do this one? Yeah, should we do? What time do we have?
It's 4:54.
Okay. Yeah, we might as well do this one.
Yeah, perfect.
Okay. The additional interest and penalties are levied on unpaid property taxes. The additional interest and penalties amounted to $35,000. The estimated uncollectible portion of the amount to be $3,800. Okay, so this kind of goes up to here. So this is where they're delinquent. So we change them over. We say, okay, these are delinquent. Now, when you don't pay your property taxes, a lot of times they add other things onto it. So this is sort of that. So what we do is we'll have fines and penalties. Something's called interest and penalties. You may have that too. But fines and penalties. Oops. Receivable. $35,000.
And that would be, so if we're assuming that goes from last year, so that would be the fines and penalties receivable. Would we say 2018 because they are for the 2018 taxes, or 2019 because they would be received in 2019?
That's an excellent question. I would say you put it in as the 18.
Okay.
It relates to the 2018 taxes.
Okay, that makes sense.
You'll have your estimated uncollectible. Oops. And you'd pick that up as revenue.
Mm-hmm.
$31,200. So you'd actually pick up additional revenue from fines and penalties. A lot of times the estimated uncollectible is high on those because if they say if they couldn't pay the regular taxes, a lot of times fines and penalties is even harder to do.
Right.
So so anyway, so this is you would put this on the books, and so this would be also on the books as revenues, fines, and penalties. And this is going to be the amount that you think you're going to collect within the 60 days. You still have to do the 60-day rule. Would apply to these also.
Mm-hmm.
We'll stop there.
Okay. Okay.
Yeah, because that's all property tax stuff. So the property taxes are huge. They're for most
Right.
most of your in a lot of your cities and that they pretty much live off those property taxes. And the nice thing about property taxes, unlike here, I tell you what, why don't you do number 4 for homework?
Sure.
All right, and so you know the property taxes. The best thing about those is that they can be used for anything. Unlike a grant from the state that says you can only use this for whatever, you can only use this for a library or something like that. Property taxes are nice because they can, you know, if the library needs it, library, if the school needs it, you know, school, fire department, whatever. So property taxes are really, if you talk to people in government, those are what they really look at. They really want property taxes. They like grants, you know, but it's not as easy to use those or spend those as property taxes. So. All right, any questions?
No. I will have number 4 for next week.
Okay, and yeah, again, it's a little bit wacky in that we have an estimated budget. That's the only thing so far that we've had on here that's kind of kooky. One thing I will say also about these property tax revenues, that this also applies for government-wide. So for governmental accounting or for fund accounting, we use these, whenever the taxes are levied, they count as revenues, and they're real revenues. The budget is estimated. These are actually real revenues. These are just like revenues in. So when they send out the tax bill, it's real revenue. All right. Well, I will talk to you next week. We should come close to either finishing this up or close to it. And then, how many classes do we have left?
Today's the 19th.
This ends the August 9th or something. So we have like 4 more classes? No, 3 more classes. Okay, so next week we'll probably finish this up. And I think the week before the end, we will, I'll give like a kind of a practice exam thing. It'll include
Comprehensive.
Only the financials. I might hopefully get into the financial statements. We'll see what we come up with. And next week I will have a CAFR report to show you.
Perfect.
If you sign off here, I'm going to find it. So, okay.
All right.
All right.
I'll see you next week.
CAFR, I'll see you